All right, time now for hot picks. Today we're going shopping in the home building sector, which has had a pretty nice run over the past couple of months. We've got Tyler Batory, he's executive director at Oppenheimer. Tyler, thanks so much for being with us. And before we get into your picks, it's actually a great day to have you because you kind of cover a broad swath of shelter. And as we talk about inflation today, we're trying to figure out what's going on with housing costs. Is it going up? Is inflation kind of backward looking, or is it forward looking indicator in terms of, where is the price of housing going? As somebody who covers the sector, what can you tell us about how elevated prices are and whether they'll continue to be?
Yeah, so it's interesting when you parse through some of the CPI data that came out this morning. It's really important to highlight that a lot of those numbers are fairly backward looking. So I think when you look forward and you look this year, our expectation is that housing prices are going to be moving lower. If you segment this out between the existing home sales market and new home sales, on the existing market, there's not really much inventory, so prices are actually fairly sticky. But on the new side of things, builders are getting more promotional, they're offering incentives, and more importantly, they are cutting price to drive sales. So it is something that stood starts showing up in the CPI data as we move through the next couple of months here.
And it's interesting against that backdrop to look at how the stocks have performed, because they're kind of signaling demand weakness. They're resorting to price cuts, as you say, and that should weigh on margins. And yet, the sector has pushed up. Why the rally?
Yeah, so a couple of things. And I think anytime you talk about housing or home builders in the United States, you really need to start with mortgage rates. So if you look last year, we started the year at about 3% on the 30-year fixed. By November, we were at 7%. That was a 20-year high. Since then, rates have generally stabilized. You've moved up a touch more recently here, but that stabilization is a tailwind. There's also a view in the market, which we would agree with, by the way, that demand really bottomed in November. That's something that you've heard from the public home builders in terms of volume, traffic, sales, better in December compared with November, and then better in January compared with December. That really sets an optimistic tone for the peak spring selling season here.
So let's get into some of your top picks. I'm just looking at your first one, Toll Brothers, which has already run up quite a bit from the lows, but you still see some 20% upside from here based on your price target. What gets you there?
Yeah, so it's really, for Toll Brothers, all about their backlog. I think it's something that's so important to highlight. They have 8,100 homes in their backlog that have already been sold. Their guidance for this year is to close 8,500 homes. They're almost basically there. And what's so important about the backlog is it gives you a lot of visibility. These are homes that were already sold, so they're going to be flowing through the financials this year at fairly high gross margin. And then because you've already had these homes sold, it really puts you in an advantageous position where you don't need to chase the market. You can actually be patient and wait for demand to improve, wait for construction times to improve, wait for costs to go down before you really step on the accelerator to try to drive some sales. So that's really where Toll is positioned right now. Their financial performance for 2023, because of that strong backlog, should be the best in the entire sector. And then, like I said, because they have that flexibility, allows them to be patient as they're building their order book looking ahead to next year.
Your second one is Polti Group, also a similar run-up. And I guess this is a question that could apply to Toll as well. Even with the run-up, it's a multiple of around 11 times, certainly cheaper than the market. But how should we think about home building multiples? Is that in line? Is that historically cheap? How should we think about it?
Yeah, so we like to use price to book, actually, just to eliminate some of the volatility in terms of earnings. So if you look at price to book for some of these companies right now, I mean, they're well below long-term averages despite the run-up in the share. So when we look at it, we still think there's a fairly negative scenario that's priced in these stocks. You look at PHM, Polti in particular, they have a similar dynamic in terms of Toll Brothers with their strong backlog, but they really have a very balanced buyer exposure. That gives them diversification, also allows them to capture strength in different buyer segments. So, they're selling to first-time buyers and have never bought a home before, but they're also selling to folks that are, moving up. They want a little bit more space as well. So it really gives them a lot of flexibility. And I think one of the key parts to the story here for Polti, and really for the entire sector, it's kind of the evolution in terms of how these management teams really approach the business. If you look at these stocks, you look at Polti, leverage is half of what it was, 5-6 years ago. Management's very focused on returns rather than just growing for growth's sake, and a really heightened focus on capital returns, share buybacks. They bought back $5 billion worth of stock since 2015. If you look at the 10 years before the great financial crisis, they only bought back 400 million. And for most of the 90s, they didn't even have a buyback program in place. So really a change in terms of how they approach returning capital to shareholders.
And why those two would you have a buy on over a DR Horton, which your market perform?
Yeah, so it's a little bit different in terms of the Horton business model. And look, I think they have an excellent management team. They have a great strategy, and they are the biggest builder in the entire sector. But their business model is a little bit different because they're selling entry-level homes, and they don't really have much of a backlog. So it's a little bit different than Polti and Toll Brothers that have that stability because they've already sold the homes and they're going to be moving them through the financials. Someone like a Horton, and they've already seen this, getting a little bit more aggressive on the price side of things. That hits your margin. You have to take some of that hit up front just because you are selling these homes to some folks that perhaps are a little bit more focused on affordability just because they never bought a home before.
And just lastly, the price of lumber obviously was a big headwind for these companies during the pandemic, and that's come way off. Do you think that's fully appreciated on the cost side of things for these businesses?
I don't think so. And it's something that's really fascinating to mention when you look at how builders and how this business model works. And we've talked about prices coming down, using incentives to drive sales. You have these offsets on the other side of the ledger. Cycle times, that's how long it takes to build a house. That's improved. That's a positive for your returns. You look at labor, wage costs, those are coming down. That's a positive for your cost structure. And then you mentioned lumber, you're at $400 right now. You were over $1,000 this time last year. So that's a tailwind as well. So yes, prices are coming down, but on the flip side of things, you do have some buffers to enhance your profitability. And as you mentioned, lumber is definitely a key part of that.